Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I'm going to talk about Spotify technology, okay, the ticker symbol SPOT, because it's a very interesting stock. It's a hot stock. Someone says it's going to be the next Netflix. It probably has a high potential on the upside. So I'm going to tell you my opinion. I'm going to discuss about the industry and the potential itself, weaknesses and strengths, and I'm going to do a fundamental valuation of it, okay? So as always, real numbers and not just random talking, okay? So leave me a like if you find this video interesting and subscribe to the channel, and let's begin. So guys, Spotify, as all we know, I think probably all of you know this thing, is basically an audio streaming company, okay, where you can listen to the music just by your phone or things, download the app, and basically it's like Netflix is for TV shows and movies. This is for songs, okay, music, and right now podcast, okay. They are pushing a lot on podcasts, so that they closed a contract with Joe Rogan and now they are on Kim Kardashian. So they are very pushing on podcasts too, okay? What is Spotify for real? I mean, what is the idea behind Spotify? So one huge problem for the music industry has always been the illegal download of songs, okay? Basically, statistics says that back in the days, more like 90% of the music that people listen all around the world was illegally downloaded, okay? So the music industry didn't get paid from that. And now it comes this man, okay, this man which is Daniel Ek, that said, well, wait, I have the solution and everyone is happy about that. Listen, I do this. Spotify, where basically Spotify, pay you, music producers and the music industry, the money you deserve. While music listeners, okay, so consumer, all the people pay me to listen to music, okay? So I put this in the middleman and everyone is happy, okay? We avoid the physical costs of producing music, like writing CDs and all those things, okay? So the real physical production of CDs and albums and things like that, we avoid this and we try to avoid illegal downloads, okay? Because the people are gonna pay for an app to do that, to listen to music. So you make money, I make money, everyone is happy, okay? So this is the main idea, and from this idea, Spotify was born, okay? So that's it. Now, since then, Spotify basically became very famous around the world, all around the world, because it's in US, it's in Europe, and it's also in other countries. And right now we have in Q1 2020 130 million subscribers, premium, okay? So people, they actually pay the subscriptions every month, okay? And those are the Spotify's revenues from 2012 to 2019. And the blue one is the premium, and we have the black one, which is the ad-supported revenues, okay? And it's very small comparing to the blue one. In fact, when we go to the annual report official of Spotify, we see that in 2019 the revenue from the premium side of the business was 6 billion and the ad-supported business was $678 million, okay, for a total of 6 billion and 700.76, okay. So as we can see here, the premium revenue comprised 90% of total revenue, okay? So the ad-supported is very small. But why is that important? This man here is going to tell us why, okay? This man here is McCarthy, which is basically the former chief financial officer of Netflix, okay? He's now working for Spotify. So basically, well, if he did well for Netflix, look where Netflix is today. Well, I hope it's gonna do well for Spotify too, okay? It's a very important personality in the business. And what it's telling us is that basically Spotify relies on its ad-supported free services to acquire paying users, okay? So the premium is the main business, and the ad-supported is like the marketing for Spotify, okay? They have this free version where basically you don't need to pay, and it's limited, okay? It's limited because you cannot choose all the music you want, and they have ads and advertisement every, I don't know, half an hour probably. And anyway, the real purpose of this is not to make money with ads, but it is to take new premium users, okay? So basically you try it, you like it, and you pay the premium, okay? To have the full unlocked version of Spotify. So that is the thing. Now, what is the problem? The problem is that even if it's free, the real problem with Spotify is that they have to pay the music industry, even if it's free, okay? So the customer doesn't pay and he listens to music, but Spotify has to pay, okay? And this is the real problem. This is an article back from 2018, but the problem is still the same today, okay? So Spotify takes 12 months on average to break even after a free user becomes a paying subscriber, okay? So what does it mean? Meaning that this ad version, this free version of Spotify, it's costly for Spotify, okay? And when someone decide to pay the full premium version every month to break even from that expensive of a marketing, okay? So to break even from the expenses that Spotify has from the free version, it takes 12 months, okay? This is actually a problem for Spotify. The real problem for Spotify, as I told you before, and they are not profitable yet, is that the more they grow and more they have to pay, okay? It is difficult to scale the business for them, okay? Why? Because music, you pay for every time that someone listens that music, okay? So basically, if numbers of users increase, well, they have to increase also the costs, okay? So this is where they are fighting, where they are trying to push economies of scale and when they are trying to increase margins. This is the main problem with Spotify. As we are going to see, it is not profitable yet, okay? So we rely on this man. Well, he did a great job on Netflix, and let's see if he's gonna do a great job on Spotify too, okay? If you read this article from Market Insider, he say that we become profitable as it scales, okay? And expects gross margins of 30-35% over the long run, okay? So we rely on this man, and basically his job is to make Spotify become profitable. Let's go to take a look at the financial situation in the balance sheet of Spotify, okay? Now in 2019, this is from the annual report, they had 6.76 billion in revenues, okay? The cost of revenues is 5.04 billion, and that gives us a gross profit of 1.72. The gross margins is 25.46%. Now here comes the problem, because the operating income is negative, okay? No, not profitable. They have a loss of 73 million, and the net income at the end of everything is minus 186 million, okay? So as I told you before, those margins are negative. Spotify is not profitable yet, okay? They have to work on scaling the business. They have to solve this problem of paying too much when new users jumps in, okay? So more the business becomes bigger and more they have to pay. They should try to fix those costs, so to scale the business and become profitable for real, okay? Let's take a look now. This is from Q1, okay? The total current assets and current liabilities we have a current ratio which is below 1, okay? It's the 0.92. Now, as a new business, well, okay, it's below 1. It makes us think, but it's a new business and they have to invest a lot, okay? So it could be okay if this thing becomes above 1 in the next years, okay? So, well, just keep this in mind, but let's not worry too much about it. In terms of total assets and total liabilities, we have that the ratio this time is 1.67, okay? So that makes us happy even with this below 1. The stockholders' equity is around 2 billion, and that the debt to equity ratio is 31%, okay? And today the market cap is around 43 billion. Again, financials, we can see the revenues increased in a consistent way during the last 4 years, but as always, when it comes to earnings, they are not profitable yet, okay? So as we see, we got a huge loss in 2017, but right now it looks like they are approaching the break-even, but we need that push that has to happen and needs to happen for the company to really start to make money. Okay, so now it comes the valuation, and how do we evaluate a company that is not profitable yet? Okay, because we cannot do the discounted free cash flows, so we have to find another way. And to try to also to understand how financial analysts work, I think you're gonna find this quite interesting. This time I'm gonna use a model which is the user-based fundamental valuations. It relies on calculating the value of existing subscribers plus the value of new subscribers, okay? Because we have already subscribers and they're gonna be new subscribers. So we have to add those things up. Plus the advertisement business value, okay? Because as I told you, we have the premium side, which is 90%, and the 10% of this free which is basically it's advertisement based, okay? It's like YouTube, and we have to add it up too. After that, what we have to do, we have to estimate the corporate expenses, RID and G&A, okay? Total corporate expenses, and of course we have to deduct them. We have to add in up the cash in the balance sheet in Q1 2020, okay? And we have to subtract, so minus the debt, okay? Minus the equity options and warrant values, okay? And all of that together gives us the common equity value. Once we have that, we divide it by the total amount of shares outstanding and we get the fair price. Okay, so that's how this model works. So basically this one, the common equity value, it should give us the market capitalization, okay, that we should see in the value that Spotify should have, okay? And keep an eye on that because actually, as I'm gonna show you, the results is quite interesting, okay? So I'm gonna now explain you quite fast this thing, okay? And I don't want to go with all those numbers for you because I don't think it's interesting for you, and I should explain how all those things is calculated, which I don't want. I should like do a couple of hours video, okay? So I don't think it's something that you are interested in. Anyway, as I told you, right now, the first thing that we have to calculate is the existing members value, okay? So we have to calculate actually how much is the value of existing. We said that right now there are 130 million subscribers in the premium subscribers, okay? So what you have to understand from all of this is that basically the assumption is that the cost per month is considered $9, okay? Because it's $9.99, I know, but there is another pack which is basically like 16 and you can have 6 accounts. So at the end of the day, when you do an average, you have around $9 as a cost per month premium, okay? So when you multiply this times 12, you have actually in the today the average, the total revenues per subscribers in 1 year, okay, which is $108. We have the cost per subscribers, and that gives us an operating profit, okay, and loss. We need to have the tax rate, which on average is considered to be 25%, which is basically how much it is in US for a corporation which is publicly traded. So that gives us an after taxes operating income. That's it. Right now, this model tries to estimate all those things for the entire life of the average user, okay, which is considered to be 15 years. Now, what we have to understand from this model, we have to understand that this model is saying, well, okay, 94% of users are going to pay again the premium in the next years, okay? So I'm gonna renew the premium in the next year. And again, when it comes to the third year, 94% of those 94% I'm gonna pay again, okay? So all the times, all the years, we have someone that says, you know what, I don't want to use it anymore, okay? And this is basically considering also around the same statistics of Netflix, okay? So that one. Anyway, after all of those things, we calculate the present value of it and we multiply it by the total amount of subscribers today. And that gives us a valuation of the existing member value of 23.376 billion, okay? This is billion. Right now, we have to calculate the new members value, okay? As the new members value, another valuation, which I don't want to go too in deep, okay, because the video becomes too long. Anyway, what you have to understand from this one is that the rate is 25% growth for the next years and 25% again for like 2022, okay? And that I estimated at 15% and the 15% for 23 and 24, and for 25 at 10%, okay? So just to be more conservative, those numbers here are in line with the company, with what the company is doing, okay? After all this valuation, we get the present value, and the present value of the new members is today 40.274 billions, okay? Now we have to evaluate the ad revenue business. We take those things which are the revenues in dollars, okay? Now be careful, because when you go to see the official report is in euro. Now I converted in dollars, okay, at today's rate. So we have revenues and costs, and that gives us operating income. When we put the tax rate, we have the after taxes operating income. And this was 2019. Now I'm gonna estimate the next 5 years. And we are considering a 15% increase in the revenues odds, okay? And what that gives us at the end of all of it, we take the present value of it and we have 3.99 billions, okay? Now, the corporate expenses. This one, we take RID and G&A. The total in 2019 was $1.049 billion, okay? And when we take the after taxes, we know that expenses becomes less because the expenses are deducted by the taxes, and we get this. Now what happens, I'm gonna try to estimate with a growth rate of 8%, okay? So corporate expenses are gonna increase at the 8% rate every year, okay? And that gives us, at the end of it, a present value of 15.94 billions, okay? So now we are at the end of it, and we have to do our calculation. And that's it, guys. So the corporate value, so the value of Spotify with this model today, we have an existing subscribers value of 23.37 billion plus a new subscribers value of 40.27 billion, plus an ads business of 3.99 billion, minus corporate expenses 15.94 billion, plus the cash in the balance sheet 1.68 billion, minus the debt, okay, 0.62 billion, minus the equity options and warrant value, which is around $2 billion, and that gives us a common shares total value of the company of $50.75 billion, okay? We divide this by the total amount of shares outstanding, and we get a fair price of $272.95 for Spotify, okay? So, considering the fact that the price today is $231.29, it looks like that with this model, the stock price is fully explained, okay? It is not overvalued. Actually, it's a little bit undervalued. Now, as always, this is a model, this is not the perfection, and I very think you are smart enough to understand this, okay? So usually what you do, when you do those valuations, you take a margin of safety, okay? You can choose whatever you want, 30%, 40%, and you deduct from the price I found to find an entry price, okay, if you believe in the company. Anyway, what we have to say is that, so with the user-based model, the price of the company is actually very explained, okay? And that makes sense with the price growth we saw in the last days, okay? Now, I think that the company is promising, okay, for the next few years. If they are able to scale the business like Netflix, we can see a 2x, a 3x increase in the price, okay? And that could happen. Like now the business is around 40 billion in the market cap. We could have 150 billion, 140 billions, okay? Just around the size of Netflix, even 180 billion, okay? It's interesting. But we have to remember that they are not profitable yet. And what I said, it becomes true if they are able to scale the business, okay? They have the former CFO of Netflix, so let's hope they're gonna be able to do it, okay? If they are able to scale the business to increase the margins and become constantly profitable, well, why not? We can see, of course, the company that can have a valuation very similar to Netflix, okay, for real. Everything relies on that. They are not profitable. Of course, there is more risk, okay? Anyway, let's see how it goes, guys. I hope you find this video interesting and leave me a like, okay? Leave me a comment below, tell me if you have a Spotify in your portfolio. Subscribe to the channel and have a wonderful day, guys.